Question as regards to technology. Fortunately, I am not today's speaker. Jordan Phillips is, and Jordan is really well versed in this. He's excellent in regards to what he does. But my thinking is before he arrives, he's going to go through a number of things. But are there any particular questions that anybody has? And I know Jay Jung had one that came up just recently, and the thought was, what about a sale in which their seller carried financing? Now, how does the seller avoid boots? Meaning anything that they collect through the sale of the property and it's not a part of the replacement property, it's a taxable event, as a matter of fact. So there's a couple of different techniques, and I'm hoping Jordan is going to be here to discuss that. But theoretically, if in the event the buyer wants the seller to carry financing, the seller, one option would be to come in with cash to replace the amount of money that he's carrying back. That is one technique that possibly is available to you, as a matter of fact. Hey, there he is. Okay. But so I don't. Sorry about no. It's not a problem. It's not a problem. George, all right.
Nice to see you. Thanks for having me
today. Yeah. We were just going to go over some questions, as a matter of fact. So now I can just begin with the introduction. You don't have to go very far. Okay. Jordan is here, everybody. Jordan Phillips is Vice President at Investment Property Exchange Services, Inc., which is also known as IPX 1031, part of the Fidelity family of companies. He specializes in structuring and coordinating delayed, simultaneous, reverse, and build-to-suit 1031 exchanges. He, on a regular basis, presents to real estate professionals on 1031 rules and regulations. Prior to joining IPX 1031, he worked as a commercial real estate advisor throughout the Western United States. He earned a Bachelor of Administration in Economics from San Diego State University and a Juris Doctorate from the University of San Diego School of Law with an emphasis in corporate and tax law. So let's welcome Jordan.
Hey, everybody. Jordan Phillips, IPX 1031. Sorry for keeping you guys waiting, but thanks for coming out. So yeah, I just wanted to kind of go over a brief overview of the 1031 exchange guidelines, what we're seeing in this market. And more importantly, if you guys have any questions about 1031 exchanges, please feel free. I like to keep this interactive. Last thing I want to do is bore the hell out of you guys on a Tuesday morning. So any questions that you have or clients that you're working with that you want to run any situations by, feel free, raise your hands. So before we get started, quick raise of hands for you guys. Who in here has kind of heard of a 1031 exchange? Somewhat familiar? Okay. Who in here has done a 1031 exchange or had a client done a 1031 exchange? All right, good. So you guys are, have a good experience level. So in a nutshell, what a 1031 exchange is, it's a code section of the Internal Revenue Code, which allows you to defer paying your capital gains taxes on the sale of investment or business real estate, which for people like us here in California is incredibly valuable because we do about 30 to 40,000 exchanges nationwide a year, and about a quarter of them occur here in Southern California, right? And that's for two primary reasons. One, properties here appreciate faster than just about anywhere else in the country, and we're also subject to incredibly high taxes, right? Like, when you blend together federal and state taxes, if you have a customer thinking about selling their investment property and cashing out and not doing a 1031 exchange, when you blend together federal and California taxes, they're probably looking at a blended tax rate of somewhere in the high 20s all the way close to 40% potentially. So that's where I get the call of, oh crap, tell me a little bit more about an exchange because I don't want to hand over a humongous chunk of my gain to the state of California and also the IRS. Any questions so far? Good. So as far as, am I kind of standing where I should be for
Yeah, you're good.
Okay.
Definitely want you.
Okay, good. As far as like doing the 1031 exchange, there are a few major guidelines that you do have to be aware of. The first is the term called like kind. Anyone heard of like kind as far as 1031 exchanges? Okay. So what the term like kind means is that anytime you do a 1031 exchange, you have to sell and buy real estate that is deemed like kind to each other. So a lot of people think, oh, I'm selling my single family rental. I have to go out and buy another single family rental, or I'm selling my triplex. I have to buy a triplex, or I'm selling in California. I have to buy in California. Fortunately, the term like kind is a lot more broad than that. So there's really only three requirements to be considered like kind. One, you do have to sell and buy real estate, right? Two, it has to be within the United States, right? So you can sell it and buy anywhere in the country, but it does have to be US for US. And also the property has to be used as either an investment or in the use of a trade or business. So things that do not qualify would be like a primary residence, a secondary home, or a short-term flip. But everything else is going to work for the exchange, right? So like if you wanted to sell your single family rental and go out and buy a duplex or a triplex, commercial real estate like industrial, retail, office, multifamily, vacant land qualifies for a 1031 exchange, like oil, gas, mineral rights, billboards, windmills, fractionalized ownership percentages like a Delaware statutory trust. All of that is real estate and can be exchanged for one another. So a lot of people do 1031 exchanges, yes, for the tax benefits, but also certainly the non-tax benefits, right? Like the ability to change property types, change property states. We have a ton of California clients who are buying out of state, right? Like going to states like Arizona, Texas, Florida, Tennessee. All of that works for the exchange, the ability to diversify, right? Sell one. Like I have a customer right now who's selling a $7 million industrial building in Los Angeles, and he's going to Nevada to buy like 10 or 15 single family rentals, right? So the ability to diversify, buy multiple properties, or a lot of our older customers, they want to do the opposite, right? They want to consolidate, right? So instead of owning, 5, 6, 7, single family rentals in Orange County where they have to go door knock on a bunch of different houses, and it's a lot of management hassle. A lot of people who will consolidate, sell multiple properties to go out and buy one, apartment complex, for example. Yeah.
I do have a question. You said this is interactive, right?
Yeah.
So in your example, if someone's selling a $7 million property here, diversifying out of state.
Yep.
Now, the state of California, that's my understanding, they're going to, if you ever divest yourself of those properties.
Yep.
And you incur a gain, they're going to recapture the ability to recover tax on the gain at the time you own that commercial property.
Yeah.
Until you sold it in California, is that correct?
Yeah, so California, the Franchise Tax Board of California, I should mention this, is even more of a pain in the backside than even the IRS, right? So they have their tools, their mechanisms to come after you for your taxes. So if you live in California, right, and you sell real estate anywhere else in the country, like for example, if I owned a property in Florida, right, and I sold that property in Florida, because I live in California, I will still have to pay California taxes on that sale. But also the guy I mentioned who's selling in Los Angeles, buying in Nevada, he also lives in the state of Nevada. So the state of Nevada is a tax-free state, meaning like if you lived in Nevada, there's no state income tax or capital gains taxes for Nevada. But like Richard mentioned, California has what's called a clawback provision. And see you shaking your head. So essentially, this gentleman who is selling in Los Angeles, buying in Nevada, when he does the 1031 exchange, it will allow him to defer paying his taxes at the federal and the state level of California. But going out of state, California is going to require that you report those Nevada properties every single year to the state of California, right? Because California is going to want to know, like, let's say, for example, I buy 10 properties in Nevada, and let's say in 5 years, I sell one of those properties and cash out. California is going to want to know so they can tax you on the gain that you made when you exchanged out of California. So that's what's called a clawback provision. So who that impacts is people who are selling California real estate, exchanging out of state, and also live out of state as well.
So you said you have to notify them every year.
Yep.
Does that mean filing a California tax return, even though are not conducting business any longer here?
Yep. So it's not a full tax return, it's an informational return. So you're basically stating that you still own the property. And if you forget to file that, the state of California will treat that as if you sold the property. So you want to make sure that every year you file that return. So it's not a full return, it's just an informational return.
Because I'd say we have a number of clients that are taking money out of the state of
Yeah.
California, going to other states to acquire property. So it's going to affect them in some capacity.
Yeah.
So it's helpful for us to be able to pass that on.
Yeah, for sure.
And California, there's no like sunset period. They will just claw that whenever you sell.
They will.
However long away.
Yeah.
That is.
Yeah. So a 1031 exchange is a tax deferral mechanism, right? Meaning like if you do a 1031 exchange and let's say 10 years from now you sell the property you bought, like you could do another 1031 exchange. There's no cap on how many exchanges you can do. But if you sell that property in 10 years and cash out, at that point, you would pay your capital gains taxes. So the only way to avoid paying capital gains taxes, which is another reason why people do exchanges, the only way to avoid paying capital gains taxes is if you hold the property until you die. So a lot of people do what's called swap until you drop, right? Exchange. And anytime you hold a capital asset, real estate included, until you die, you get what's called a step up in tax basis, meaning that all of your gain that you accrued during your lifetime gets wiped out upon death. So a lot of our clients say, hey, look, I'm just going to exchange, right? Like it's kind of interesting. You'll see kind of the life of someone who owns real estate, right? Like when they're younger, they might be, wanting to buy property for, appreciation purposes, right? And then they get a little bit older and then they might want to transition. This is where we have our clients who go out of state, right? They might want to increase their cash flow, right? So they go buy properties in, Texas or somewhere like that. And as they get older than that, their main goal is to, kind of reduce their management burden. And then that's where they go into kind of these passive investments, like a Delaware statutory trust. So it's interesting to see kind of how people utilize exchanges throughout their life to better suit their real estate portfolio. And they do that until they pass away. And then all of their gain gets wiped out upon death as well. So there's definitely a lot you can do, with the exchange. What I mentioned that you cannot do is buy something like your primary residence, right? This comes up a lot, right? So you can't sell or buy a property that you've been using immediately before the exchange or will move into right after the exchange. The good news is that any property that you've lived in for 2 of the last 5 years, you can take advantage of the primary residence exclusion, right? So like, for example, if me and my wife, we've lived in a property for the last 2 of the last 5 years, we sell it, we could exclude the first 500,000 of capital gains on the sale. If I wasn't married, it would be 250. And that does not apply to investment properties. That's for your primary residence. Now, what happens a lot of times is, hey, look, I'm going to, sell my investment property. I want to maybe retire down in, La Jolla, right? Can I buy a property that I immediately move into? The answer to that is no, right? But back in 2008, the IRS actually did come out with clear-cut guidance as far as how long you have to wait before you could move into the property after an exchange. And that holding period is 2 years. So any property you buy through a 1031 exchange, if you hold it as an investment property for 2 years, so 24 months, after 2 years, the IRS has come out and they've said via a revenue procedure that after 2 years, they can no longer challenge the validity of the exchange. So if you want to buy a property, rent it out for a couple of years, move into it, that's totally fine. So we see that a lot. A lot of our customers are motivated by their kids and their grandkids, right? So like, hey, I have grandkids that live in, Washington State, right? Like maybe I want to buy a property in Washington State, rent it out for a couple years, and then I can use that as, you know, my second home to visit my kids, grandkids, right? So we see that a lot, as far as ways to potentially use the property for personal use after that 2-year period. Yeah.
What if it's the other way around? Like if I have a single family home
Mhm.
that I live in right now, and then I want to rent it, and then do a 1031
Yep.
exchange, can I do that?
Yeah, you certainly can. So going back to my example, let's say, you know, that $500,000 exclusion, especially here in Southern California, oftentimes people who own properties for like 30 or 40 years have significantly more than 500,000 of gain, right? So back in 2005, the IRS came out with a revenue procedure that allows you to combine both the primary residence exclusion with a 1031 exchange. So like going back to my example, right? Let's say my wife and I were going to sell our property that we've been living in. Let's say we have $1 million of gain, right? So like if we just sold it now, we would take the $500,000 exclusion, and the other 500,000 of gain, we would pay capital gains taxes on. But we don't want to do that, right? So like you said, you know, the 2-year period also applies to the property that you're going to be selling. Like if we moved out for 2 years, held it as a rental property, and then sold it, the IRS would say that that qualifies for a 1031 exchange. So we move out for 2 years, we sell the property. We still qualify for the primary residence exclusion because we've lived in it for 2 of the last 5 years. We could pocket the 500,000 exclusion, and then we could 1031 exchange the rest. So it's a 2-year period if you want to convert your primary into an investment before an exchange, and it's a 2-year period converting an investment property to your primary after the exchange.
Should, was the 2 years during the ownership be consecutive?
Or
So if I own a primary residence and I want to convert it to a rental property because I want to exchange it eventually.
Yeah.
Plus the 2 years where the investment property as held as investment property must be consecutive.
they have to be the 2 years leading up to the exchange.
I see.
Yeah. Yeah. Another thing that comes up a lot too is because housing prices are not very affordable, to say the least, for the younger generation. We get clients who ask, hey, can I buy an investment property and rent it to my kids? Exactly. That comes up like a lot, right? So if they're going to be renting the property to a related party, right? So like kids, grandkids, grandparents, parents, if you're going to be renting a property to a related party within that first 2 years after the exchange, the IRS is going to want to see 4 things, right? So let's say I'm renting the property to my parents, right? Like there's going to have to be a valid rental agreement between me and my parents. They're going to have to be paying fair market value rent to me. I will have to be reporting that rent as income, and the property will have to be used as their primary residence. So those are the 4 requirements. So if you're renting to a related party, the IRS will treat that with a little bit more scrutiny than normal. But if you meet those 4 requirements, renting to a related party works for the exchange. And then, like I said, after 2 years, IRS doesn't care how you use the property. So if after 2 years you said, hey, look, mom and dad, I'll be a nice son, you don't have to pay me rent, or you can pay me below fair market value rent after 2 years, that would also be fine.
I'm sorry to interrupt.
Yeah.
So if I understand the guidelines there, but if mom and dad give their children, their offspring, the money to make the rental payment, I assume we can just use that to offset.
Like, hey, fair market value rent's $4,000. I'll give my kids $4,000. They give it back.
$4,000 a month every single.
You could theoretically do that. You have to make sure there's no personal, gift implications. But then that,
or you could just, it would just reduce the amount of the gift
correct.
aspects.
Right. But then I'm still gonna have to report that 4,000 as income.
Yeah.
Yeah. So you could theoretically do that. Or like what we have sometimes is like,
You mean the recipient would have to report that as income?
yeah, like if I'm let's say,
Oh, no, I understand the payment from the
Yeah.
beneficiary, right?
yeah. Or sometimes we'll have people get creative and say, hey, look, fair market value rent for this, single family rental is $5,000, but you're going to be like for example, if it was my parents, like they're going to be the property manager, they're going to take care of it. So like I'll reduce the rent by a couple $1,000 as kind of payment for them being a property manager. We see that. So there's ways that people's CPAs get a little bit creative with that. But long story short, the IRS does want to see those requirements met. Another thing that comes up as well, as far as like, can I buy a property with my kids? Right? Like, hey, my son or my daughter or whatever, they want to buy a property in, Phoenix, right? Can I do my 1031 exchange to buy a property with them? Right? Because they might have a little bit of a down payment, but not enough to buy a property. The answer to that is yes. In a 1031 exchange, you can buy replacement properties with other investors. The key is that you do have to sell and buy as the same taxpayer, right? Like if I sold a property, I can't go out and buy a property with my kids under a new like LLC or partnership, because that would be a different taxpayer from me individually. But what you could do is you can go out and buy the property as tenants in common, right? Like we each buy a fractionalized ownership in a property. So like if I'm doing a 1031 exchange, my son has some money, he wants to buy a property in Phoenix. Let's say he's got 10% of the down payment. I've got 90% that I could do in an exchange. Like we can go out and buy a property together as 90-10 owners, right? So that would work for a 1031 exchange. So getting kids involved, whether or not it's buying a property that they live in or buying a property together, is another way that we're seeing exchanges heavily utilized in this market, with interest rates being where they're at and housing prices where they're at as well. So that's the good news about the exchange, that there's a lot you can do with it. Now, the hard part about doing the exchange is the fact that there are strict timelines that you need to be aware of. So anytime you do your 1031 exchange, there's two time frames that you must abide by. The first is the identification period. So I should probably go back a little bit as far as the mechanics of actually doing the exchange. So let's say, for example, you have a listing and your customer is going to be doing a 1031 exchange. So the listing process would remain relatively the same, right? So you list a property just as you ordinarily would. You get the property under contract into escrow. At that point, that's when I would formally become involved as what's called a qualified intermediary. So anytime you perform a 1031 exchange, the IRS actually requires that someone like us facilitates the exchange. So that encompasses a couple of things. One is, before the sale closes, we would have to prepare a set of 1031 specific documents that the exchanger would need to sign. So I want to emphasize, before the sale closes. So you cannot set up a 1031 exchange after the closing. And I get that call like once or twice a week. Hey, look, I just closed on the property 2 days ago. The money is still sitting in escrow. Can I set up a 1031 exchange? Answer to that is no. So the exchange has to be set up with someone like us before the sale closes. We can get an exchange set up like in a day. So like if you're closing today and need to set up an exchange, it's not ideal situation, but we could do that. So we get that set up, and then once the sale closes, that is when the official clock will start for the exchange. So from the closing, the exchanger will have 45 calendar days to identify the property or properties that they want to buy, and a total of 180 days to complete the purchase. Any guess on which one of those two time frames is the more challenging?
45 days.
45, exactly. Yeah, 45 days comes and goes pretty quickly, but to my surprise, I actually did research on like what percentage of our clients in Southern California in the last 1 year completed their exchange. Any guess on the percentage?
That'd be pretty high. I would say 95%.
93. Yeah, I thought it was lower, but I guess now a little bit more, maybe a buyer's market relative to previous years. But yeah, 93% of our clients in the last year completed their exchange. So although it is pretty intimidating time frame wise, most of our clients, especially the ones that are working with a good real estate agent that are proactive, more often than not, they will complete the exchange. So the ones who don't complete the exchange, typically speaking, are the ones that procrastinate, right? A little bit lazy, right? Maybe they don't start shopping until day 30 or 40, and it's like, okay, come on. But most of our clients, once they get the property into escrow on the property that they're selling, that's when they start shopping, right? So they go out, yeah.
So how do you define identifying, like, this, I showed there's like 4 properties that I would offer, but then I failed to buy one of these?
Yeah. So identify, what that means is at the closing, we will provide the customer with an identification form. So what we need within the 45 days is a list of the property addresses. So properties don't have to be under contract or in escrow in order to be identified, but we do need an unambiguous property address. You can identify multiple properties. The IRS does limit how many properties you can identify. So there's 2 identification rules, and you can pick one or the other. So the most common is what's called the 3 property rule. So what that says is if you identify 3 or less properties, the properties can be any value, right? So most of our clients, about 68% of them, do a 1-for-1 exchange, right? They sell one, buy one. So they'll use the 3 property rule. They'll identify their primary choice with a couple of backups, and they just have to close on one of them. So you don't have to close on all the properties you identify. So most of our clients will use that 3 property rule. But like my buddy who was selling for, LA and buying 10 or 15 single family rentals, like he's going to need to identify more than 3 properties. So alternatively speaking, there is what's called the 200% rule. So what that says is if you identify 4 or more properties, the total aggregate value of those properties that you identify cannot exceed 2 times the value of the property that you are selling. So like if you're selling for $1 million and you say, hey, look, I want to identify 5 properties, you can, as long as the aggregate value of those 5 properties does not exceed $2 million, right? Or 2 times the sales price. So those identification rules, you can pick one or the other. Like I said, most people use the 3 property rule. Within the 45 days, you can change those properties as much as you want, right? Like if you say, hey, look, here's my 3 properties, it's day 10 of my exchange, and then you fast forward to day 40 and all 3 of those properties are no longer available, you can take them off and put 3 new ones on. So within the 45 days, there's unlimited flexibility, but that final list of properties you do have to choose from. So after day 45, the IRS does not allow for any changes. In fact, the only time the IRS allows for an extension on those timeframes is due to a federally declared disaster. Like, for example, last year in Los Angeles, because of the fires, the IRS released a disaster relief extension, which applied to the general tax filing deadlines and also 1031 timeframes. But those are things that we're not really necessarily hoping for and that are not very common. So absent some sort of federally declared disaster, those timeframes are hard and fast, right? So there's no way to extend those timelines absent a federally declared disaster. Yeah,
Does the property you close on have to be one of the 3 identified properties?
it would. Yeah.
And then the expiration, it falls on a weekend or legal holiday, it expires on that day.
Yeah.
Right? So there's no reprieve going to the next business day.
Yeah. So like if your 45th day is on a Sunday, like you have to get that in by end of the day on a Sunday. If your 180th day, so you have 180 days total to close on the purchase. Like if your 180th day is on a Sunday, you have to close on the Friday before, right? Because you can't close the next day. So, like I said, the 180 days, that is usually not a problem. The only time I see that become somewhat of an issue is in the event of buying like new construction, right? Where the property might not be finished. until after day 180, especially some states like, buying a property in Montana where, they don't even work for like 6 months out of the year to build properties, right? Because of the snow. So that comes up, somewhat here and there, but otherwise it's usually the 45 days. If there's any issue with completing the exchange, it's the ID period. Another thing that comes up as far as, kind of working around somewhat of those timeframes is what's called a reverse 1031 exchange. So reverse exchange is, hey, look, I already found a property that I want to buy. Like I got a call from a customer yesterday. They're selling and buying in Ohio, right? The customer's parents live in Ohio and he wants to buy a property that he's going to be renting to his parents. The problem is that he's selling a property in Columbus, right? And he's buying a property in Cleveland, right? But the property in Cleveland that he wants to buy, it's like on a street that he's always wanted to buy on, and properties come up on the market once every 5 years. And one property just so happened to come on the market, and he has to pounce on it and close on it now, and he hasn't even listed the property that he's going to be selling. Fortunately, in that situation, you can do a reverse exchange. So that's where you buy first, and then from the closing of the purchase, you have 180 days, calendar days, to close on the property you're selling. So that gets a lot of people excited, rightfully so, right? Because usually selling a property in 180 days, especially if it's priced right in the right market, usually not a problem. With that being said, reverse exchanges are certainly a heck of a lot more complex than a regular 1031 exchange. Reason being, in a reverse exchange where you buy first, the IRS says that you cannot be on title to both the property you're buying and the property you're selling at the same time. So what happens in a reverse exchange is us, the accommodator, during escrow on the purchase, we would actually have to form a new LLC. We use that LLC to assign in to the position as the buyer of this new property. And at the closing, our LLC would actually take title to this new property, and we would remain on title until the property which is being sold closes. So as you can imagine, there's a couple of complexities with that. One, a lot of our customers will need the money, right, from their sale to go out and buy this property, which they won't have, which oftentimes leads to them having to get a loan on the purchase. And getting a conventional lender on board to one of those transactions is challenging, to say the least.
That's a very good point.
Yeah. So typically speaking, people who do reverse exchanges who need a loan usually will get some sort of short-term financing, bridge loan, to wrap up the purchase, and then refinance after the exchange is over. Also, the cost goes up significantly on our end. So for example, a regular exchange where you sell and buy, we charge $1,000, pretty straightforward. Reverse exchanges, you're typically looking at about $6,000 to $7,000, plus the cost of an LLC, which in California is about $800 or $900. So when it comes to cost, complexity, if there's a loan involved, reverse exchanges aren't necessarily as popular as you might think. I would say they probably make up about 5% of our overall exchange activity. But it is, for certain facts and circumstances, a great alternative. Like for example, the gentleman who is buying in Ohio and just has to close on it, he actually had the cash as available as well. So for certain people it works, but more often than not, people will just do a regular exchange.
Just going over the fee again.
Yep.
When you're doing it, it is just $1,000 flat fees on this delay.
For a regular exchange,
Yeah.
yeah, that covers the sale and also purchase. Yeah, it's a pretty straightforward fee.
Then questions come about reverse exchange
Yeah.
quite often, actually, about this. So if you wouldn't mind reiterating the point that Fidelity is going to take title to the property in the LLC, or they're going to be the member that owns the
Single member, yeah.
LLC, correct? So it's virtually impossible for the person who's participating in the reverse exchange to obtain or use that as collateral to obtain financing. Does that make sense? So I find a property.
Yeah.
You create the LLC, it's in Fidelity's name or Fidelity is the member. I can't use that as collateral to obtain a loan.
I mean, so usually what happens is like, we can go on the loan, but what happens, the exchanger will usually personally guarantee the loan as well. Or maybe cross it against another property that they own. But yeah, getting financing is definitely challenging for the exchange. So during the actual exchange, you're right, IPX, that's our company. We will be the single member of the LLC. The exchanger, let's say you're doing the exchange, you would be the manager of the LLC, so you'd still be signing all the documents. Yeah, as far as the loan is concerned, like I said, usually it is some sort of bridge loan, where the lender is actually familiar with.
Collateralized against something else
Yeah.
other than that particular.
Yeah, like they'll either personally guarantee the property or cross it against maybe a different property that they own.
And then that LLC is filing tax returns every year till it's dissolved.
Well, so
How do you manage that?
Well, so during the exchange, yeah, we would be the single member. And then what happens at the end of the exchange is, let's say, you close on the property you're selling. We can go off title in one of two ways. Going off title meaning transferring you the property. Usually what we'll do is we'll just assign you the LLC. So that LLC will be what's called disregarded for tax purposes if you're the single member. The reason we do that is because it helps to usually avoid transfer taxes and a second, title and escrow. Or if you said, hey, look, I don't want to take over the LLC, we could just deed you the property directly and then dissolve the LLC ourselves. But on that, there'll be extra closing costs and potential
There's
transfer
added
taxes.
complexity. That's really what it comes down to.
Yeah. So, I mean, honestly, it's like, I don't want to scare people from doing reverse exchanges. It's just that some people get this like rosy picture that it's just like really easy, but there's definitely a lot more layers that they just have to be aware of going into it.
Yes. Thank you for clarifying that.
As far as the next major guideline and how we're doing on time, you said about.
No, we're fine. We're
Yeah,
fine.
okay. So rule 1, sell and buy like-kind real estate. Rule 2, do it within the time frames. Rule 3 is, how much do you actually have to buy for, like value-wise, to defer paying all of your capital gains taxes. Like some people think, oh, I just have to reinvest my gain, or I just have to reinvest my equity. So the number the IRS looks at as far as value is you take your gross sales price and you subtract, your non-recurring closing costs, right? Like commissions, or not commissions, but title fees, escrow fees, transfer tax, and then also commissions as well. So deduct your non-recurring closing costs and commissions off the gross sales price, and that is how much you have to buy for or hire to defer paying all of your capital gains taxes. So like if you sold after closing costs and commissions for $1 million, to be completely tax deferred, you have to buy for $1 million or higher. Within that, there's one or potentially two components. One is the equity, right? So the cash that you have coming out of that sale. You have to roll all of the net proceeds from your sale into the next purchase, right? So any money that does not get reinvested from the sale into the purchase is what's called boot, meaning you would pay capital gains taxes on the leftover cash. Another thing that trips up clients is that the IRS also requires that you replace the value of any debt that you're paying off. So going back to my example, let's say you sell for $1 million, and let's say you have 800,000 of cash, and you're paying off a $200,000 loan. Step 1, you have to buy for $1 million or higher. Step 2 is you have to roll all 800,000 of that cash into the next purchase. And step 3 is that you have to replace the value of that $200,000 loan that you're paying off, right? So you can do that in one of two ways. You can go out on that purchase and get another loan for $200,000 or more. Or alternatively speaking, this comes up here and there because of where rates are at. If you wanted to bring in $200,000 of extra cash to buy the property, you could do that as well. So the IRS just requires that the debt value is replaced. Whether you do that with another loan or additional cash, that part is up to you. Yeah.
when you do a tentative exchange and sell your property, the sale doesn't cover, doesn't pay back the lender.
It does, right? So it's like, let's say you sell for $1 million, you after closing costs, whatever. Escrow will pay off the loan as well. So the net 800,000 that comes into us, the accommodator. So the IRS requires that we hold the funds in between the sale and the purchase. When you go out and buy, let's say you want to buy another property for $1 million, we would send the 800,000 to escrow. And then however you make up that $200,000 gap, whether it's getting another loan or bringing in 200,000 of additional proceeds, that's the part that's up to you.
But in some cases, I'll be forced to just take out a loan.
Yeah, most people do get another loan, but you have that flexibility. Now, if you wanted to buy a property less in value, this comes up a lot as well. Like, let's say I sold for $1 million and I want to buy something for 900,000, right? So there's $100,000 delta. A couple of options. One is you could do what's called a partial 1031 exchange, meaning that you would pay taxes on that 100,000. So just because you bought down in value does not in any way, shape, or form invalidate the exchange, but you would pay taxes on the difference. Option two, if you have 100,000 left over, you could buy a second property, right? Like as we talked about, you could buy multiple properties, so that's totally fine. Or option three, this comes up a lot as well, is can I use that 100,000 to improve the property that I'm buying? Like this property I'm buying is great, but it needs a new roof, it needs a new driveway, it needs a new kitchen or whatever. Can I use that 100,000 to make those improvements? Answer to that is yes. There is what's called an improvement 1031 exchange. Similarly speaking, it is pretty much the same as a reverse 1031 exchange as far as the structure is concerned. So the reason being is if you want to improve the property, you can't improve real estate that you already own as a part of an exchange. So similar to the reverse exchange, we would form an LLC. At the closing of the purchase, our LLC would go on title to the property. And then as the work is done, like for example, as the roof is done, we would pay the contractors. As the kitchen is done, we would pay the contractors. Maybe you're building a pool, we'd pay the contractors for that. And then any work that you get completed within that 180 days, you could also add to the exchange value. So let's say, for example, you find the $900,000 property, you do the improvement exchange, we pay out, for completed work, the remaining 100,000. We then transfer the property to you at the full $1 million value. So improving the property is also something you can do as a part of the exchange. Any questions?
Find out about that, but something we run into much more often now are non-resident aliens wanting to avoid withholding upon the sale of a property.
Yeah.
So they want to engage in a 1031, hoping to avoid the tax consequences. Can you talk about that?
Yeah, so if you're basically a non-resident alien, there is what's called a FERPTA withholding. So essentially what would happen is that people would, sell their U.S. real estate. They don't have a U.S. taxpayer ID number. They would just take their money and never report the gain on any sort of tax return. So the IRS implemented a FERPTA withholding, which is essentially a 15% withholding on the sale of real estate. So what that does is it incentivizes them to then, report their taxes, because maybe 15% is more than they would have owed and they can maybe get a refund. But in any event, it's just a way to kind of capture a projection of the taxes that would have been owed from that sale. Obviously, when you're doing a 1031 exchange, there are no capital gains taxes, right? The code section 1031 exempts you from capital gains taxes. So that does significantly impact someone with the FERPTA withholding. Because let's say I sold for $1 million. Let's say I own the property free and clear. Let's say I'm not a U.S. taxpayer. There's a requirement by the buyer to withhold 150,000 of that million. So the problem is, well, I had 850,000 to reinvest when I need to reinvest 1 million, right? So like if I only reinvest 850, that 150,000 that I don't have because of the withholding is going to be boot, subject to taxes. So there's a couple of ways that you could potentially work around that. One is I could in that example, I could deposit an extra 150,000 with escrow, right? So like escrow closes, 850 from the buyer plus my own 150 comes into the exchange. That way there's 1 million in the exchange account. I use that towards the purchase. I then file my taxes. I report a completely tax deferred exchange and I get that 150 back, right? So that's one option. Option two is there's basically a withholding exemption form called an 8288B, which would exempt you entirely from that FERPTA withholding. But the problem is in order to basically submit that application, you have to submit it with, basically the purchase contract for the property you're selling. You have to submit the purchase contract for the property you're buying, and it could take the IRS like up to like 2 or 3 months to even like get of the results on that filing. Yeah. So like in the meantime, like you probably have already closed on the sale, and like so getting that exemption, it's very time consuming. A lot of things have to fall into place. So usually speaking, most of our clients who had that FERPTA withholding will do the first option and just put their own money in.
So if they don't have a taxpayer ID, they're non-resident alien, they can deposit that additional money.
Yep.
And then 150,000 that's withheld, that's still remitted to the IRS, correct?
Still remitted, then they have to report the exchange, and then they would theoretically get that refund.
Once they file a tax return,
correct.
and that requires getting a taxpayer.
Yeah, there's kind of I-10.
Yeah, I guess the point I'm trying to bring forward is there's no way to avoid the withholding if you don't have a taxpayer ID. The
No.
1031 exchange will not defeat the funds that are to be withheld.
No, it won't unless you can get that exemption, which like I said, could take like 2 or 3 months, which doesn't usually work with the timeframes because they have to, like I said, submit the contract for the sale, contract for the purchase. So unless it's like a super long escrow on both, you're probably not going to close. You're probably not going to get that result back in time before the closing.
No sellers are prepared for that.
Exactly. Yeah.
They're just not.
Yeah. So FERPTA is a kind of a pain in the backside. Yeah.
Those are the only 2 options.
Yeah. Yeah. And that's the same thing that comes up with the same exact issue that comes up with like seller financing in an exchange, right? Like let's kind of move on from FERPTA, but use the same example on a seller carryback, right? Like let's say you're selling for $1 million and the buyer says, hey, look, I can't come up with the cash. I can't come up with financing. Like, can you carry back a note? So let's say I carry back, same thing, 150,000 in seller carryback. It's the same problem, right? You're missing that 150,000 that should be coming into the exchange. So same thing as FERPTA, like I could basically bring in my own 150,000 and loan the buyer cash basically as a way to avoid it. Yeah.
What if the seller absolutely does not want the extra money to escrow, and they want to just try the 8288 extension that you're talking about? What's the probability? I mean, how is it usually successful to do that, or does it fail often?
Like as far as getting the application accepted, I don't know what the stats are, but the problem is it could just take the IRS up to a tremendous amount of time to actually provide a response.
Okay.
So like if you're closing in 30 days and it's going to take the IRS 90 days to get you a response, that's kind of where the problem arises.
What if you closed, the withholding was already withheld, right?
Yep.
And then the IRS comes back a month or 2 later and says, oh, you're approved. There's no way you could go back and.
So the problem is like, who's going to hold that money?
Yeah, the withholding agent only has 21 or 22 days
Yeah.
to remit the withholdings to the IRS.
Yeah. Yeah. So I don't know if any
Export. So
title escrow companies are going to hold on to that for,
they can't.
Yeah.
Yeah.
and the buyer's not going to want to hold on to it, right? Like they don't want the liability. So that's the biggest problem too, is like that 150,000, like who's holding it until that determination is made, which by then,
And the 50% is only on gains, not the
That's the total sales price.
15 to
The
20.
Yeah.
gross selling
Yeah.
price, plus 3 1/3% from the franchise tax board too.
Yeah.
The only option is to file a tax return to recover. the
Yeah.
money.
Yeah, and for us, as far as like facilitating the exchange, we can't even open up a 1031 exchange account unless they have a taxpayer ID number. So either an EIN, a social security number, an ITIN, because we have to open a bank account to hold these funds. We can't open a bank account without a taxpayer ID number for the exchanger. So that's a big thing for us as far as actually even being able to facilitate the exchange, is that we also need that taxpayer ID number.
What if they do have a account here, they just don't live here? Do we skip the withholding?
That, I would say that they would want to run that by their own tax advisor to see if maybe they can work around not even having to, file the FERPTA withholding. That's not something that we generally would get, involved on as far as advising. Yeah.
No, but it's the buyer's obligation to withhold money in the event the seller is a non-resident alien. So the obligation on the buyer is severe.
Yeah.
So the IRS could come after them, not only that, but the buyer has to keep the documentation in regards to having a taxpayer ID for 5 years following the close of escrow. So there is no benefit. And then the withholding agent escrow is representing the buyer in the sense they have an obligation to remit that money. So there's really no way around it. It's very difficult. I don't know how you get around it unless you have a taxpayer ID.
Yeah.
And then people think, well, I can transfer, I'll grant deed my interest to somebody, my son or daughter has a taxpayer ID. Well, that's considered a sale. And that buyer has an obligation to withhold the funds anyways on the sale of the property. So tax planning.
Yeah.
Right? The
Yeah.
taxpayer ID.
Yeah, FERPTA stuff for sure. That comes up, you've been seeing that come up?
Oh, yeah.
Yeah.
Yeah, we've had a number of transactions in which we remitted to the IRS on the franchise tax board,
Wow.
and it's a substantial amount of money.
On that note, so, kind of, like I said, I'll hang around, but kind of wrap up what I do. So like I said, I'm with IPX 1031. So we're the nation's largest qualified intermediary. So like I said, we do about 30 to 40,000 exchanges nationwide a year. We are wholly owned by Fidelity National Financial. So our sister companies with Lawyers Title, Fidelity Title, Chicago Title, Ticor Title, Commonwealth, which is very important because our industry, believe it or not, is actually federally unregulated. Pretty ridiculous considering we're holding about $5 billion currently of active exchange funds. I guess the IRS deemed the 1031 exchange qualified intermediary industry is not worthy of devoting significant resources to monitoring. So basically any one of you guys could say, hey, look, I like 1031 exchanges. I'm going to open up a QI tomorrow and start taking in customers' money. So that is kind of scary, to say the least. So just know that we, as the intermediary, we carry the highest levels of bond and insurance of anyone in the country. Our parent company personally guarantees each of our exchange accounts up to $50 million. And we are very, very stringent on the banks that we work with. So our parent company has a treasury department that is monitoring the banks that we work with on a daily basis, which has reduced the banks to Citibank, US Bank, and City National. So those are only 3 banks that we currently work with to hold our clients' funds.
So that being said, when you said you're insured and everything, what can go wrong where you would they have to pay something out?
Well, I mean, there's a lot of fraud, right? I mean, we're very vigilant on everything, but there's errors and omissions insurance. So like if one of our employees messes up, there's a fraudulent act, something gets lost or stolen. We have a $100 million fidelity bond, a $30 million E&O policy, and that $50 million performance guarantee, which kind of covers all of those incidences. So you'd be surprised. I mean, our company, like I said, we're large, we're very professional, but there's some small, like 1-man shops, 2-man shops. And when you're dealing with this kind of high frequency volume transaction, very time sensitive, things can happen, right?
But nothing to do with the parties, right? Because they're independent.
No, it's the accommodator.
Yeah.
Now, I was gonna bring that up. I would never recommend anyone else other than this company as a matter of fact, because it is completely unregulated. So how do you know the accommodator is insured properly, that they're going to be there Because if they just take the money, then what? So I would never recommend anybody, as a matter of fact, it's surprising what could possibly take place. And then if you're the one recommending that to your clients, they're gonna be looking at you for recovery of those funds.
My favorite is when they do it over $75.
Yeah.
ABC.
Yeah, I
company-
pay an extra $100 or $200 to have that security, right? So I know that my, or you think about it, if you are participating in a reverse exchange, you're parking that property with an LLC in
Yeah.
which they are the single member that owns that property.
Yeah.
So there's a lot of risk for someone who's participating in a 1031 exchange unless you know who you're working with. Any other questions? No, Jordan, thank you
Sure,
very
you
much.
got it.
It's always a
Thank you.
pleasure. Let's give it a hand. Thank you very much.
Appreciate it. It's nice to have you.
If we want to do the drawing, sure, let's do the drawing. Did everybody turn their business minutes in?